The year is 2000, and Enron is not just another company. It is being treated like the blueprint for American corporate dominance. A massive Houston skyscraper, a famous tilted E logo, a stock price that seems unstoppable. To the outside world, Enron looks like the future. The numbers looked insane. Enron had more than 20,000 employees, reported over $100 billion in annual revenue, ranked as the seventh largest corporation in America, and had been named Fortune magazine's most innovative company for 6 years in a row. But then the music stops. The beautiful glass headquarters falls forward like a cheap movie prop. Behind it is not a strong company. It is a burning wooden scaffold held together with duct tape, shredded documents, and desperation. Because behind the glass, the numbers told a different story. Enron was not a miracle. It was a mirage, a giant corporate illusion built on fake profits, hidden debt, aggressive accounting, and a culture that rewarded people for making the lie bigger. By the end of 2001, the stock would collapse from more than $90 a share to just 26 cents. Thousands of employees would lose their life savings, and Enron would file for what was then the largest corporate bankruptcy in American history. This is the data-driven truth of how the so-called smartest guys in the room fooled Wall Street, regulators, employees, analysts, and almost the entire world. And more importantly, this is how the math finally caught up with them. The paper trail starts in 1985. Kenneth Lay merged Houston Natural Gas with an Omaha-based company called InterNorth. The result was a massive interstate pipeline business. He named the new company Enron. Originally, Enron was simple. It moved natural gas from point A to point B through thousands of miles of pipelines. Stable business, real assets, real infrastructure. But to Wall Street, it was boring. And boring does not create a superstar stock story. Then Jeffrey Skilling entered the room, a brilliant, aggressive consultant from McKinsey with a completely different vision. He did not want Enron to just transport energy. He wanted Enron to trade energy like a financial product. His idea was radical. What if natural gas could be traded like stocks, bonds, or commodities? What if Enron could become the marketplace instead of just the pipeline? That idea changed the company forever. But Skilling joined on one major condition. Enron had to change how it recorded its money. And that change opened the door to one of the most dangerous accounting tricks in modern corporate history: mark-to-market accounting. Here is how the trick worked. The day Enron signed a long-term contract, it could immediately record the projected future profits as if the money had already arrived. Not actual cash, not money in the bank. Just an estimate of what they hoped the deal would make someday. So if Enron signed a deal that might make hundreds of millions over 20 years, it could book those profits today. If the deal later failed, the beautiful number was already sitting in the books. This gave Enron the power to look rich on paper while actual cash barely walked through the door. And once Enron discovered this accounting trick, it did not stay a tool, it became a drug. Every new contract became a chance to invent future profits today. Every optimistic estimate became a number Wall Street could celebrate, and every quarter, the company became more addicted to showing growth that actual cash could not support. The problem was simple. Wall Street did not reward boring stability. Wall Street rewarded growth. So Enron's executives learned to feed the market exactly what it wanted: bigger numbers, louder stories, and the illusion that the company could turn almost anything into profit. Inside Enron, the stock price became the scoreboard, not customer value, not long-term cash flow, not operational discipline. The stock price. If the chart went up, people were heroes. If the chart slowed down, somebody had to create a new story fast. Skilling helped build a culture that worshipped aggression. Employees were told they were the smartest people in the room. They were pushed to take bigger risks, close bigger deals, and treat doubt like weakness. The company did not just want performance, it wanted believers. Then came the infamous internal ranking system. Workers were constantly judged, ranked, and pressured. The lowest performers could be pushed out. On paper, it sounded like meritocracy. In reality, it created a survival game where looking successful became almost as important as being successful. That culture created a dangerous incentive. If your bonus, reputation, and job security depended on showing growth, then the easiest way to survive was to make the numbers look better. And once everyone is rewarded for the appearance of success, the truth becomes an inconvenience. Enron no longer wanted to be seen as a pipeline company. That was too boring. It wanted to be a trading empire. Gas, electricity, broadband, weather contracts, water, even ideas that barely made sense. If Enron could attach a market price to it, they wanted to trade it. At first, this looked brilliant. Enron Online became one of the largest internet trading platforms in the world. Deals moved fast, volume exploded, reported revenue skyrocketed. To outsiders, Enron looked like it had invented the future of energy markets. But here is the uncomfortable question. If Enron was making so much money, where was the cash? That question sounds simple, but it cuts through the entire fraud. Because revenue can be reported, profits can be estimated, but cash either enters the bank account or it does not. This is where Enron's story becomes less about innovation and more about deception. The company needed to keep looking profitable, even when deals disappointed, so losses had to be hidden, debt had to be moved, and the balance sheet had to stay beautiful at all costs. Then Andrew Fastow enters the story. As Enron's chief financial officer, Fastow did not just manage the books. He helped build the machinery that made the books look clean. And that machinery was powered by something called special purpose entities. A special purpose entity is not automatically illegal. Used properly, it can separate risk for a specific project. But Enron used these structures like secret closets. They pushed ugly assets, debt, and losses out of sight, then showed investors the clean room. The trick depended on distance. If Enron could make it look like another company owned the risky asset, then Enron did not have to show the full damage on its own balance sheet. It was still connected. It was still dangerous. But it looked separate enough to fool people. Fastow's structures became even more dangerous because some of them involved conflicts of interest. He was the CFO of Enron, but he also had influence over partnerships doing deals with Enron. In plain English, the person guarding the vault was also building tunnels underneath it. One of the most infamous examples was the LJM partnerships. These partnerships allowed Enron to move assets and risk around, while Fastow and others could personally benefit from the deals. The conflict was not a small footnote, it was the engine. Then came the Raptors. These were special entities designed to protect Enron from losses on investments, but the protection was often backed by Enron's own stock. That meant Enron was using its own inflated share price as a shield against losses created by its own bad bets. Think about how fragile that is. If Enron's stock stayed high, the hedge looked powerful. If the stock fell, the hedge weakened. And if the hedge weakened, Enron would have to admit losses, which would push the stock lower. The entire system fed on itself. At this point, Enron's stock price was not just a reflection of the business, it was oxygen. The company needed belief to survive. If investors kept believing, the machine could keep spinning. If belief broke, the machine could suffocate almost overnight. That is why the story had to be protected. Analysts had to stay impressed. Employees had to stay confident, Regulators had to stay behind. And investors had to believe the numbers were real, even when the numbers were becoming harder to explain. But cracks were starting to show. Some outsiders began asking a simple question: how does Enron actually make money? Not in slogans, not in press releases, not in innovation awards, in cash. Real, traceable cash. That question was dangerous because Enron's business model had become a maze. It was energy, but also trading. It was pipelines, but also finance. It was broadband, but also derivatives. The more confusing it became, the easier it was for executives to sound brilliant while saying almost nothing. And this is one of the oldest tricks in finance. When a business cannot be explained clearly, some people assume it must be genius. But sometimes complexity is not sophistication. Sometimes complexity is camouflage. By 2001, the pressure was building. Enron had spent years promising endless growth. But the stock market was weaker, tech enthusiasm had cooled, and Enron's own structure was becoming too heavy to hide. The company had to keep running faster just to avoid falling apart. In August 2001, Jeffrey Skilling suddenly resigned as CEO. Officially, it was for personal reasons. But to the market, the timing felt strange. The man who had sold Enron's future was leaving right before the future started asking questions. Kenneth Lay returned to reassure everyone. Employees were told the company was strong. Investors were told the business was solid. The public was told the story was intact, but behind the scenes, the paper trail was starting to smoke. Then came Sharon Watkins, an Enron vice president who warned Kenneth Lay that the company could implode in a wave of accounting scandals. Inside the tower, someone had finally said the quiet part out loud. Her warning mattered because it came from inside the machine. This was not a short seller yelling from the outside. This was not a jealous competitor. This was an insider looking at the structure and seeing that the foundation could not hold. Around the same time, journalists and analysts were getting more aggressive. The questions were no longer polite. Why was the company so hard to understand? Why was cash flow so weak? Why were insiders selling? Why did the numbers feel too perfect? Then October hit. Enron announced a huge loss and a massive reduction in shareholder equity. To ordinary people, that sounded technical. To the market, it sounded like the first official crack in the wall. Soon after, news broke that Fasto's partnerships were not just side details. They were central to how Enron had been hiding losses and debt. The thing investors thought was a footnote was becoming the headline. The SEC opened an inquiry. Fasto was removed, rating agencies started circling, creditors became nervous, and Enron, a company that depended on confidence, suddenly had to survive without it. This is where the collapse accelerated. Enron's business required trust. Trading partners had to believe Enron could pay. Banks had to believe Enron could borrow. Investors had to believe Enron could survive. Once trust disappeared, the company's oxygen disappeared with it. Denergy tried to buy Enron, but even that rescue deal collapsed. Once buyers looked closer, the hole was too deep. The company that had spent years selling certainty could no longer convince anyone of its own value. The stock began collapsing in public, not slowly, violently. What had once traded above $90 was falling toward pennies. The market was not repricing Enron. It was finally admitting that the old price had been fiction. And the people crushed hardest were not the executives who had already cashed out. It was the employees. Many had retirement savings tied to Enron stock. They believed in the company. They worked in the building. They wore the badge. And then the badge became a trap. Imagine watching your retirement account disappear while the people at the top tell you everything is fine. That is the human cost of financial fraud. The spreadsheet loses numbers. Real people lose years. On December 2nd, 2001, Enron filed for bankruptcy. The company that had marketed itself as the future of business had become a warning label. The skyscraper was still standing, but the story inside it had collapsed, and Enron did not fall alone. Arthur Andersen, one of the most respected accounting firms in the world, collapsed after the scandal. The auditor that was supposed to protect trust became another casualty of the same system it failed to challenge. The scandal reached Congress, courtrooms, and every business school in America. Executives were investigated, charges were filed, careers were destroyed, and the public learned that a company could look world-class right up until the moment it vanished. So how did Enron fool so many people? The answer is uncomfortable. It had all the symbols of legitimacy: big headquarters, famous auditors, Wall Street analysts, Fortune magazine awards, political connections, high stock price, everything people confuse with safety. But legitimacy is not the same as truth. A famous auditor can miss fraud. A rising stock can hide weakness. A confident CEO can sell fantasy. And an innovation award does not mean the cash register is actually ringing. This is the first lesson. Always separate reported profit from real cash. Profit can be estimated, adjusted, delayed, accelerated, and massaged. Cash is harder to fake. If the earnings look amazing but the cash flow is weak, start asking questions. The second lesson? Beware of businesses that become impossible to explain. Complexity is sometimes necessary. But when complexity becomes the entire defense, when every question gets buried under jargon, the jargon may be protecting something ugly. The third lesson: incentives predict behavior. If executives get rich when the stock rises, they may protect the stock price at all costs. If employees are punished for missing targets, some will manipulate the targets. Systems do what they reward. The fourth lesson: culture matters. A company that worships arrogance will eventually punish honesty. When everyone is told they are the smartest person in the room, nobody wants to be the first person to say the room is on fire. And the fifth lesson: the market can be fooled longer than you think. Enron did not collapse the first time it made a bad decision. It collapsed after years of bad decisions were stacked high enough that the weight finally broke the structure. That is what makes Enron so important. It was not a simple villain story. It was a system story. Bad accounting, weak oversight, broken incentives, analyst trust, employee faith, and investor greed all connected into one machine. And that machine worked until it did not. That is the most dangerous part. Fraud often looks strongest right before it breaks, because every hidden loss, every delayed truth, and every desperate trick is being used to keep the illusion alive. This is why Enron still matters today. Because every market cycle creates new companies that sound unstoppable, new buzzwords, new models, new ways to explain why old rules do not apply. And every time people want to believe the story, but old rules do apply. Cash still matters. Debt still matters. Incentives still matter. Governance still matters. And when a company tells you not to worry because everything is too complex for ordinary people to understand, that is exactly when ordinary people should start worrying, because the smartest people in the room were not smart enough to escape reality. They could move numbers, they could hide debt, they could pressure employees, they could impress analysts, but they could not create cash that did not exist. And in the end, that is what killed Enron. Not one headline, not one bad quarter, not one whistleblower memo. The collapse happened because the gap between the story and the cash became too wide to cover. So when you hear about Enron, do not just think of fraud. Think of the pattern. A company becomes celebrated, the stock rises, the language gets complicated. Skeptics are dismissed, insiders get rich, employees trust the brand. Then suddenly, everyone asks how nobody saw it coming. The answer is uncomfortable. Many people did see pieces of it. But seeing a red flag is not the same as acting on it, especially when the stock is going up, the awards are coming in, and the people raising concerns are made to look negative. That is the psychological trap. People do not just invest in companies, they invest in stories, and once a story becomes profitable, they defend it emotionally even when the numbers start begging them to leave. Enron's greatest product was never energy, it was belief. Belief from employees, belief from analysts, belief from investors, belief from the media. And once that belief vanished, the company did not slowly decline. It disappeared. That is the real data-driven truth behind Enron. It fooled the world because the world wanted to be fooled. The numbers were confusing, the profits were exciting, the executives sounded confident, and the stock chart made skepticism feel stupid. But math has a way of collecting unpaid bills. You can delay losses, you can rename debt, you can move risk into side structures, you can polish the story. But eventually the cash has to match the claims. And when it does not, the collapse feels sudden to everyone who only watched the surface. But for anyone watching the cash, the incentives, and the structure underneath, the ending was being written long before the final headline. That is why this story is not just history. It is a warning. Anytime a company asks you to trust the vision while ignoring the cash, anytime complexity becomes a shield, anytime insiders get rich while employees take the risk, remember Enron. Because companies do not collapse when the first lie is told. They collapse when the lies become too heavy for the truth to carry. Enron built one of the biggest corporate illusions in American history, and when the illusion finally broke, it did not just destroy a stock, it destroyed trust. So the next time a company is called unstoppable, revolutionary, too innovative to question, or too smart to fail, ask the boring questions first. Where is the cash? Where is the debt? Who benefits from the numbers? And what happens if the story stops working? That is how Enron fooled the world. Not with one trick, but with a system. A system of fake profits, hidden debt, aggressive culture, weak oversight, and a market that loved the story too much to check the math. And that is how everything collapsed. The smartest guys in the room were not beaten by a competitor. They were beaten by reality. What do you think? Was Enron a one-of-one scandal? Or is the same pattern still hiding in modern markets? Drop your thoughts in the comments, hit subscribe, and I will see you in the next one. If you enjoyed the story of how Enron fooled the world, then you'll love the story of Michael Burry. Everyone thought he was crazy. Click the video on your screen now. I'll see you there.